RH, the home goods store, slipped more than 10% last week after they reported their third quarter earnings, in which they missed analyst expectations. The CEO said he expects macroeconomic headwinds to persist throughout the remainder of 2023, further pressuring the luxury housing market. So you can see, if we go to the monthly chart, how price was bid up into a level that served as resistance and then support, and became resistance once again at the round hole psychological number of $400 last month. Now this red extended range candle is the gap down on earnings. Before we continue with the analysis, let's look at this article as we go in depth on their earnings that they reported last week. So the stock tanked as much as 15% after the high-end furnishing retailer warned the housing market continues to pose challenges and likely won't stabilize until next year. The CEO said, "We continue to expect the luxury housing market and broader economy to remain challenging throughout fiscal 2023 and into next year as mortgage rates continue to trend at 20-year highs, and the current outlook for rates to remain unchanged until the second quarter of 2024. Now, our second quarter earnings were $3.93, which was above estimates of $2.48. Net margins of $800 million was also above expectations of $777 million. Third quarter revenue forecast for $740 to $760 million came in below Wall Street consensus of $774 million. RH, better known as Restoration Hardware, has been warning about the slowdown for the last several quarters. Last June, the stock took a hit after the California-based company warned it saw signs of softening demand. All right, so to kind of summarize what we just talked about in this article, let's look at this 2-minute clip from Yahoo itself.
Restoration Hardware, yeah, shares are slipping today. Very nice mirrors there too, I will say. After the company's CEO warned that the current economic backdrop would remain challenging for those mirror sales throughout fiscal 2023 as mortgage rates remain at 20-year highs. What's the correlation? Of course, if people aren't moving into new homes, maybe they don't need a new mirror, or they can just build it into the one that they're already got under construction. Anyway, Restoration Hardware, some of the details here, particularly as you kind of think through the environment that they've had to navigate, where, of course, they're looking at what the pace of home sales may look like, but also in the home furnishings environment. That is, of course, a discretionary purchase that has been challenged over the last year, and that is going to be a continued headwind or a macro headwind or factor that the company has to acknowledge in this environment too.
Yeah, I mean, and this is partly an expectations game when it comes to this stock, because the shares are up 38%. Most of the analyst commentary I've seen has not been that negative. It's just a matter of, can they meet what is being priced in that kind of share performance. The company's third quarter forecast is as much as $760 million. So it's a little bit short of estimates. It's not hugely short of estimates, but when you've got a stock that has climbed as much as it has, even if it is not that short of estimates, you see a punishment like we are seeing today for the shares.
Yeah, and keep a close eye on margins too with this company. Margins 47.5%, at least their GAAP gross margins. Their adjusted gross margin 47.5% as well, versus 52.8% last year. And so if there is even some moderating in that margin base, especially given the fact that this is not cheap goods that they're selling into people's homes. I mean, I remember walking into one, and you always walk in one, it's kind of like dark and brooding, but a very sophisticated dark and brooding that it has. And so you come to expect a very high value, high cost as well type of purchase that many of their customers are making. And we'll see exactly how they sustain some of these margins.
So if we look at the weekly chart, again, this is that monthly support resistance band that we discussed earlier in the video, where price came up, left a tweezer candle formation, and then it kind of dropped. The first test was, you can't really see it, but this is a rallying price. You got a little basing candle and then a rally. That basic candle is a doji, and as you can see, price came, depending on how you draw your zone. Let's just do it now. I like to draw my zones like that. You can also draw your zone like that to the top of the range of that doji candle, and you can see price did hit the top of the zone and then shot up. Eventually, on earnings, price breached the weekly zone at 325. Now, zones in the middle can work, but typically zones in the middle show a balance between buyers and sellers, which is kind of why, well, in this case, the momentum was just too great after earnings, and this was a news catalyst that caused price to close below this level here. But I prefer to play the extremes, right, as that is where you have the stronger imbalance. In this case, on the top side, the sellers far exceed the buyers, and down at this $200 weekly level, the buyers super exceed the sellers. And so it's best to kind of just play the extremes. As in the middle, you can expect more chop. You know, this is the monthly chart, and you can see you had a drop in price, a basic candle, and then a drop. That was a zone which held several times. In this case, if you want to go in the middle, it's best to go with the momentum. So if I go down to the weekly, let's see. Yeah, the momentum was to the downside. You know, this was the zone that we saw on the monthly chart. Price came up twice, but that's the only way I would consider buying or selling in the middle, is kind of going with the short-term trend. Nevertheless, let's take this zone off. As I mentioned, based on what the CEO was saying about the macro picture, you do have buyers down here at the 235 level, but the weekly buyers level at 200 sets up as a bear trap, meaning if price continues to decline and eventually breaks this support level, you're going to have the support resistance traders shorting the stock, only to be met with the imbalance of buyers and sellers. And I would anticipate if and when price comes back down to this level, you should get a pop in the stock. However, I would not go long at this point. I don't think the sell-off was enough. I do see further declines, again, at least to another 60, 70 point decline as we head into the end of the year and in 2024. Thanks for watching. Subscribe. Please like the video.